Picture this. April 2013. It's a quiet Friday morning. Asian markets open normally. Gold is trading just above $25,560 an ounce. Silver near $27. Nothing unusual. No wars, no banking failures, no headlines screaming panic. Then, in less than 72 hours, gold collapses $200 per ounce. Silver drops over 15%. Roughly $1.6 trillion in market value evaporates, one of the largest commodity crashes in modern financial history. With queries, the strange part. No vaults were looted. No mines collapsed. No physical gold flooded the market. In fact, physical demand surged so violently that coin dealers across the US and Europe ran out of inventory entirely. So how does an asset collapse while people are desperately trying to buy it? Now rewind further. September 1980. Gold crashes 65% over 2 years. September 2011. Gold peaks, then bleeds for 4 straight years. March 2020. Gold is sold aggressively right in the middle of a global lockdown. Same pattern, same confusion, same false explanations. This instant random. It's not market sentiment. It's not retail panic. This is structural, deliberate, repeating. And today, the same three forces are back larger, faster, and more leveraged than ever. That's the story. And what comes next is not what most investors expect. Here is the hidden truth. Gold and silver don't crash because they fail. They crash because they work, and the financial system cannot tolerate that at critical moments. History shows that every major precious metals crash is driven by 3 repeatable forces. Liquidity crises that force paper liquidation, policy regimes that weaponize interest rates and currencies, derivative markets that overwhelm physical reality. By the end of this video, you'll understand exactly why gold and silver were smashed, why this has happened repeatedly for over a century, and most importantly, what history says comes after these crashes. Because the crash is not the end of the cycle, it's the middle. Quick pause. If you're realizing that financial headlines never explain why things really move, and you want history, not hype, subscribe to this channel. This is where financial history is dissected without central bank talking points or asset management spin. Now let's break down the first force. Force 1. Liquidity crisis, force paper gold to D. Let's start with the most misunderstood concept in finance. Liquidity. Not money, not cash. Liquidity. Liquidity is the ability to settle obligations immediately. And when liquidity disappears, everything is sold, even assets people believe in. Case study number 1. The 2008 financial crisis, September 2008. Lehman Brothers collapses. In the 4 weeks that follow, gold falls 28%, silver collapses over 50%, mining stocks lose 60, 80%. This confuses people. Gold is supposed to protect you during crisis, right? But here's what actually happened. Large institutions weren't selling gold because they lost faith. They were selling gold because it was one of the only liquid assets left. Margin calls don't care about ideology. Hedge funds had borrowed against equities, mortgage securities, credit derivatives. When those imploded, brokers demanded cash. Immediately, gold futures, highly liquid. Silver futures, highly liquid. Sell button pressed. Meanwhile, physical demand exploded. US mint silver coin sales hit records. Premiums detached from spot prices entirely. 2 markets, 2 realities. Case study number 2. March 2020, the pandemic panic. March 2020, global markets freeze. Treasury markets malfunction. Even money markets wobble. Gold drops 12% in 8 trading days. Silver drops nearly 40%. Why? Not inflation expectations, not confidence loss. It was a global margin call. According to the Federal Reserve's own emergency filings, over $2.3 trillion in liquidity was demanded by primary dealers in less than 2 weeks. They sold everything. But again, physical reality told a different story. Silver Eagles sold out. Gold delivery delays stretched to months. Swiss refineries shut down. Reading physical shortages. Paper price down. Physical scarcity up. That's not a failure of gold. That's a failure of market structure. Mechanism breakdown. Here's the key insight. Gold and silver crash during liquidity crises because they are liquid. They are collateral. They can be sold quickly to meet obligations. The assets that truly fail don't crash. They freeze. That brings us to force number 2. Force E2. Interest rate regimes one Vipentais perception gold does compete with stocks. Gold competes with interest rates. More precisely, real interest rates. The brutal math of gold yields nothing. So when nominal rates rise, inflation is perceived to fall. Gold becomes politically inconvenient. Case study number 3, Paul Volcker and the 1980 gold crash. January 1980. Gold peaks at $850 an ounce. Paul Volcker, newly appointed Fed chairman, raises the federal funds rate to 20%. Real rates turn positive. Gold collapses 65% by 1982. But here's what most narratives omit. The U.S. debt to GDP ratio in 1980 was 31%. The government could afford high rates. Today, U.S. debt to GDP exceeds 120%. A Volcker-style rate regime today would bankrupt the Treasury, the housing market, the banking system, which means rate hikes today are mostly theater, and markets are starting to realize it. Case study number 4, 2011-2015. The taper illusion gold peaks in September 2011 at $1,921. The Fed hints at tapering QE. Rates rise modestly. The dollar strengthens. Gold falls 45% over 4 years. But inflation didn't disappear. It went into asset prices, housing, healthcare, education. Gold wasn't wrong. Timing was. Gold discounts policy credibility, not press conferences. And when credibility breaks, gold reprices violently. Which brings us to the most dangerous force of all. Forn 3. Derivative markets over whale physical, a reality. This is the buried mechanism. The one almost never explained. Paper gold versus physical gold. For every ounce of physical gold, COMEX trades 100,130 paper, claims London OTC markets. Add opaque leverage ETFs. Introduce rehypothecation risk. Silver is worse. Estimates suggest 300 plus paper ounces per physical ounce. This means price is not set by supply and demand. It's set by positioning and leverage. Case study number 5. April 2013. The gold smash. April 12, 2013. Over 400 tons of paper gold sold in 2 days. That's 15% of annual global mine supply. Dumped during illiquid hours. No physical seller behaved this way. This was positioning liquidation. Large funds exiting leveraged trades. Price collapsed. Physical demand surged. Premiums disconnected. Again, why this always happens at inflection points. Paper gold exists to provide liquidity, suppress volatility. Channel demand away from physical delivery until it doesn't. When too many people want out at once or want delivery, the paper structure becomes unstable. Price collapses first, then resets higher. This pattern repeats. 1974, 1976, 2008, 2011, 2013, 2013. We are in the same window again. Here's the brutal truth. Gold crashes are not bearish events. They are stress tests. They reveal where leverage is hiding, where policy credibility breaks, where paper claims overwhelm reality. Mainstream commentary treats gold like a stock. It is. Gold is a monetary asset trapped inside a speculative system. Every major crash occurs before currency debasement accelerates, before fiscal dominance becomes visible, before trust fractures. In 1933, gold was confiscated after it bottomed. In 1976, gold bottomed before inflation exploded. In 2001, gold bottomed before the credit supercycle peaked. Crashes cleanse weak hands. They don't invalidate the thesis. They validate it. Now look around. Global debt exceeds $310 trillion. Central banks hold over $13 trillion in bonds. Real rates are negative across most developed economies. And yet, gold is volatile. Silver is crushed. Confidence is confused. Meanwhile, central banks bought 1,037 tons of gold in 2023, the highest level in modern history, led by China, Turkey, and emerging markets. Do you see the divergence? Paper markets say, no problem. Official buyers say, systemic risk. The same three forces are active. Liquidity strained beneath the surface. Policy theater masking fiscal reality. Derivative leverage distorting price signals. The next phase historically follows this sequence. Paper liquidation exhausts, physical demand asserts itself. Currency confidence erodes, gold reprices not gradually but suddenly. This is not a prediction, it's a pattern. Let's recap. Force 1. Liquidity crises force gold to be sold not because it failed, but because it's liquid. Force 2. Interest rate regimes weaponize perception, but only while credibility lasts. Force 3. Paper leverage distorts price until physical reality snaps back. Gold not move first. It moves last, and violently. Picture that Berlin bakery again. The sign didn't change gradually. It changed overnight. The pattern is mathematical, predictable, historical. The only question is whether you recognize the setup or wait for confirmation from headlines that arrive too late. If this analysis helped you see the system more clearly, subscribe and watch the next video where we examine which assets actually survive the reset when paper claims fail. Thanks for watching. Now go study history before it repeats at your expense.